think we'll get started here. Andy, do you want to kick us off?
Yeah, absolutely. Well, thank you, everyone, and hello and welcome. Today, we're going to be discussing how to define and quantify impact tolerance as part of an operational resilience strategy. I'd like to start off by thanking everyone for joining, and I'd like to introduce ourselves. So, Bryce, if you'd like to go ahead and introduce yourself.
Certainly. Thank you, Andy. Hello, everyone. My name is Bryce Madsen. I work as a professional services team lead at Infinite Blue within our customer success department. Really looking forward to diving into impact tolerances here with you on this webinar and to be doing it with you, Andy. So I'll let you do your spiel.
Thanks, Bryce. My name is Andy Witts. I'm the Senior Director of Alliances at Infinite Blue. I work with a lot of international companies and our partners, so hence my interest in operational resilience. So thank you and welcome. So today, before we actually dive into some of the weeds of operational resilience and specifically impact tolerance, I'd like to recap. I realize that a lot of people joining may be very much dealing with the details of operational resilience, and some people may be fairly new to it. You might be in an industry that not necessarily is mandated to do operational resilience. So let's do a quick overview before we dive into the details. You may hear the words enterprise resilience, organizational resilience, operational resilience come up. At Infinite Blue, the way that we take a look at it is we take a look at enterprise resilience being the overall encompassing umbrella for all of the various different disciplines. There are many areas of resilience and continuity that have sprung up depending on what your level of responsibility and your purview is. So, for example, if we take a look at business continuity, traditionally that has always been focused around recovery of our critical processes should a failure arise. When we take a look at risk management, we're looking at preemptively at trying to anticipate and sort of think about what threats could occur that would pose a risk to us and what controls and mitigations can we put in place in order to avoid that risk. When we take a look at supply chain, whether we call it vendor management, supply chain, third-party risk assessment, we're essentially assessing the things and the other companies and outside sources that we depend upon. Are there any single sources or sole sources that we're dependent on? If an incident occurs, and especially geographically, it could affect us as much as it affects a vendor we depend on. So what does our network and what does our flow look like? From an infrastructure standpoint, or disaster recovery, as it's also known as, we take a look at the applications and the actual hardware we depend on. So much of what we do is digital and is dependent upon the applications and the data that we have access to. Should that fail, what's our strategy? Can we fail over and fail back successfully? Can we restore and recover applications within an adequate time frame? Now, I've left governance and training, and we have them on the ends because it really encompasses everything. The training and awareness to make sure that we have the right embedding policies in place to make sure that people know what to do and where to get the information they need should an incident or a failure occur. And also from a governance standpoint, we want to make sure that we're audit ready and we're monitoring and aware of all of the various different things that we are on the hook for to be able to prove and validate that we are resilient. Now, I left operational resilience till last deliberately because that's where our focus is going to be today. For those of you who are actually in the financial or insurance sector, especially in the United Kingdom or in Europe, operational resilience is something that's been come forward from the Bank of England. Now we have FCA and PRA regulations, which Bryce will talk about in just a moment. Essentially, the construct of operational resilience focuses on maintaining the level of operations and services that we have, defining what the tolerances are, and Bryce will talk about this in a bit more detail in just a moment, and then also testing this out to make sure that before we even get to a point of having to recover, what are the metrics and what are the things that we can tolerate? Are we trending in the wrong direction? Where are the thresholds where we need to set an alarm and be aware of we may have an impending event or disaster before we even get to a point of having to declare a disaster and having to recover? So with that said, let's move on, and I'll hand over to you, Bryce, for you to talk a little bit about some of the regulations.
Certainly. Thank you, Andy. Yeah, we saw from the United Kingdom, we had the FCA and the PRA define some regulations for banking, investment firms, and insurance companies. So the Financial Conduct Authority, the FCA, they defined requirements for banking and investment companies specifically, and they came into effect last year in March 31st. So as part of the March 31st, 2022 requirement, banking and investment firms had to have identified important business services and had to have identified tolerances for those services. And then by March 31st of 2025, they have to prove out that they are mapping and testing and staying within those tolerances. The Prudential Regulation Authority, the PRA for short, they provided similar requirements in the statement of policy that essentially laid out the same thing. So identifying important business services, having impact tolerances set for those services, and then doing the necessary mapping and testing to prove out that they're staying within and doing the necessary mitigation for their services. More recently, we saw Digital Operational Resilience Act come out of Europe, DORA for short, and this came into effect just this year. So DORA encompasses what the FCA and the PRA lay out in terms of operational resilience and that methodology, but DORA also includes a tie-in to risk analysis. So they spell out requirements for information and communication technology on risk management, reporting, incidents, testing for third-party risk management, as well as third-party providers and cloud service providers. So those are just the regulations that have come out more recently. And what I'd like to do now, Andy, is just go over what we have defined and what we know and come to think of operational resilience based on these regulations. So we've broken it down in past webinars in 5 components here. And I'm just going to walk through each one and just kind of do a brief overview. So the first step with incorporating operational resilience within your organization is identifying key business services, so service mapping. And coming from a traditional business continuity practice, Andy and I certainly had to think through this when we were first learning this. Services can easily be confused as processes, or they might seem like they're similar. But it's important to note that services are actually a layer higher than processes. So you very well are going to have multiple processes supporting a service. And just to give a brief example of that, let's say you're a bank and banks offer mortgages to their customers. The mortgage is the service, and then doing the credit check, doing the underwriting to support the mortgage are those processes supporting that service. So once we've identified our critical business services that support our business, we move on to what we define as service functions, or really identifying key data points that we can use to set our threshold. So in this phase, you'll want to think of how your services impact your customer, and then ultimately how your service is going to impact your company, and pulling out data points to set our tolerances so we can understand our risk appetite. And I'm going to spend a little more detail on this in the next slide, just to kind of confirm some areas that you can look at and some data points you can think about when you're doing your analysis on your services. So that will naturally roll into and feed into setting our impact tolerances. And this is really the core of operational resilience. Andy and I, this is another area that, coming from a traditional business continuity practice, that could be easily confused as recovery time objective, but it's very different. This is going to be proactive, whereas recovery time objective is post disaster or post disruption. So these are going to be thresholds, and they're going to be indicators that we're going to try to use to help us from going down a path that could lead to a disaster or a disruption. So just a quick example here to really prove out like what are impact tolerances and what that means for your business. Just think about human healthcare and especially someone who might have a heart condition. They're routinely going through getting checkups where they're monitoring their cholesterol, they're monitoring their blood pressure, and doing other various checkups. And if any of those checkups are going to provide back information that is above the thresholds that the doctors have defined for normal human heart with heart conditions, they're going to take the necessary steps to get the medication or take those steps to become healthy again. So it's really how we see operational resilience and our impact tolerances fitting in with overall enterprise resilience. It's that proactive, preemptive approach. So once we've defined the tolerances, scenario exercising is arguably going to be one of the more important components here for operational resilience. Because in this phase, we're going to want to do a lot of testing to validate where our services are exceeding tolerances and where our gaps are. And we'll spend some more time in this webinar kind of going over factors you can test, what you should be thinking about when you're doing your scenario exercises. But just briefly here, we're really looking at some smaller risks or the smaller gaps that might go under the radar in traditional business continuity practice. And then finally, monitoring governance. This could really overlay across all the previous core components. Just as Andy was saying, this is going to be something that we're routinely updating what we've set before and defined before. And we're taking our feedback from our exercising, from real life scenarios, and we're making the necessary adjustments that we need to make to support the business. All right, so going back to service functions, how can we measure these? Like I said, we really want to have a focus on our customer impact as well as our company impact. And the intent here is not to be, we know we're not going to be cookie cutter with laying out all these examples of data points that you can use or the examples that you'll hear throughout this webinar. But the goal is to give you an idea and provide you maybe the right mindset that you can use to take this assessment back to your own organization and to identify your own specific services and data points that you need to use. So here are a few examples for some data points that we can use to track and think about how it might impact our customer. So transactions. So we can think about the total quantity of transactions it might take to complete a service. If they were like a call center and we're managing support calls that come in from our customer, the quantity of those transactions, so what's the normal quantity there? Also the rate, how fast are we getting this completed? The staff needed to support a call center and to support the number of transactions. And then for direct customer impact, like wait times that we know a customer will find acceptable. And then finally, data availability, whether a customer can't have access to data on a website or your own employees do not have access to data that's going to translate and negatively impact the customer. And while you're doing this analysis and you're thinking of some data points to pull out, also think of scenarios that you could envision your company going through. I'll use an example here, going back. So let's say you're a bank, and just like, and so banks who offer mortgages, let's say the interest rate drops And that's going to likely prompt an influx of customers calling in to get a refinance on their loan. That's an example of scenario and a likely situation that a company that's a bank could find themselves in. So thinking about those scenarios and how that would impact and have an impact on those data points is all very good to do when you're identifying and picking apart your services here. Andy, I'm going to pass it over to you to speak more on company impact specific data points.
Thank you, sir. So picking up from where Bryce left off, and I'll sort of reiterate one of the things that Bryce was saying about transactions. Not all of these metrics are going to apply to every product or service that you're going to need to assess. Some may be some more relevant than others. So for example, as Bryce had mentioned, transactions or rate of transactions. We've all seen in a call center, for those of you who've been in a call center, you may see that if calls are starting to stack up and wait times are starting to increase, that's going to increase a poor customer perception. How many of us have been on the other line where we've been on hold for a long period of time? How does that feel? Doesn't create a good customer perception. Now, although that on its own isn't necessarily an incident and necessarily something that would lead to business continuity, if it continues to trend in that direction, we're heading towards an issue. So how can we put measures in place in order to monitor what direction we're trending? It might be transactions, it might be rate of transactions, it might be staff availability. When we think about a department, so for example, if somebody calls out sick, not a problem. Normally the manager of that department handles it, will divvy up the work and separate things out. But what happens if two people call out, and how many is too many calling out sick before we realize that we actually have a problem and we cannot cope with the workload and the bandwidth is going to be limited and we're going to start to see problems. How much can we tolerate if we have staff availability while there's an increase in transactions? Because as we know, the way things happen, what can go wrong will go wrong. Two different things could combine at the same time. What happens if data availability is limited and we can't get to the applications? How many times have you actually wanted to get online or check your account? What would be the perception to customers if they couldn't access their data or they couldn't change their data and they have their own personal emergency? How does that affect our SLAs? We may have certain promises and certain uptime SLAs, as well as promises to customers that we're supposed to deliver. How is that going to affect us in terms of an increase in complaints? For those of you familiar with it, an NPS or Net Promoter Score could get lowered, which is essentially your rating as in terms of the support and the service you offer. How would losing an offshore team impact an onshore team? So, for example, we're all in a situation where we're fairly global in many cases, not in all cases. But if we have a handoff point to an offshore team, if something happens geographically, how is that going to affect our onshore team? Do we have the bandwidth to cover? Do we have enough people cross-trained where we can pull people off of other tasks in order to take over and help us with what we need to do? So getting your mind into this, when we take a look at what the FCA outlines, and I realize that not all of you necessarily may be under the purview of FCA or PRA, but we're going to talk just for a minute about SCA and how does that apply to everyone and how could you potentially use this? Because one of the takeaways we'd like you to have is not just how do I pass an audit, but could I potentially improve the overall resilience of my organization? Some of you may not necessarily be under the purview of the FCA or PRA, but you may be under DORA, or you may not even be in the financial sector, but you want to see more about operational resilience because you see this as an opportunity to improve resilience for your organization. So we do take that into account when we take a look at this. Focusing back on the FCA for a moment, the FCA doesn't get too prescriptive on what impact tolerance should be in terms of what metrics you should measure. At least the last one I looked at it. And when I looked over their regulations, it was things like the number and types of customers adversely affected and the nature of the impact. Would there be a financial loss to the consumer if something trended in the wrong direction? Could there be a financial loss to the firm? Or could that effectively in turn affect the firm's or the UK financial system? If you're not in the part of the UK, part of whatever the financial system you're part of, or any of the financial markets. what potential damage could this do to your reputation? And how could it harm the firm's consumers or the financial markets? What kind of impact would this have to market or consumer confidence? Would this cause a spread of risks to other business services? For example, if we think about if a particular product or service is starting to falter or having a problem with it, are we pulling too many resources to deal with this less critical product or service, and then that's having an impact on a more critical product or service? If we lose functionality or access for consumers, which is something I just mentioned, what happens if a consumer cannot access their account or can't access or can't call, or there's no availability or accessibility? How did it feel if you were on the phone to an agent on a call center, and you had to sit and wait because systems were running slow or you get passed around? It doesn't create a good customer experience. And then also, when we think about all privacy regulations and the expectations of data, how would any loss of confidentiality or integrity of the data, or even availability of that data, impact us? And for those of you not familiar, CIA is something that's of great importance in the cyber world. So that's how the FCA defines it, but we're going to talk about how do we quantify our impact tolerance. Bryce, would you like to talk a little bit about some of the rates and some of the things that we measure?
Certainly, yeah. So pulling out from, and this is going to look similar to what we saw for data points for identifying our service functions. But you might think about time, customer wait time it might take for individuals to complete transactions, things like that. So time is obviously a very easy metric to use to help define our impact tolerances. And then, as we mentioned, rate, transactions, flow of operations, those sort of things, and SLAs. Those are all going to be very kind of easy, tangible things that you can pull and use into your impact tolerance setting. Then we can also look at financial loss. So if you have certain penalties that are tied to your services, that can be an indicator, or even just expenses that are going to need to be taken for compensating for some sort of impact. You can also use percentages to identify what's your minimum percentage that you need in order to run normally and function normally. And then you can also try to have some indicators that are tailored to the market, to the consumers, to the business in terms of what would be harmful to each of those three categories. As Andy mentioned too, if your services are very dependent or have downstream impact to other services, what's the quantity that you would need to identify to take proactive measures and to avoid that disaster? So you can use your other service impacts as an identifier for your impact tolerance. And then we mentioned staffing too, quantity of staffing, or if you have key teams where you're shifting from a daytime team to a nighttime team, what's going to happen if you lose one of those resources or they're not available? So Andy's going to speak more about how we can use all this data, how we can use these quantities or these quantifiable metrics to break it down even further into really defining and categorizing our impact tolerances here.
Thanks, Bryce. So when we talk about it, let's break it down, and this is really the reason why I think most of you are probably here. Let's break it down. How do we get our arms around this and turn this into something we can use? Because when we're talking about a lot of high-level information, that's great, but then how do we measure it, and how do we actually turn it into something physical and something tangible? So when I took a look at this, and I looked at the various different types of metrics and the method behind operational resilience, I thought that this breaks down into categories. I mean, you saw the metrics that we just talked about in the previous slides. Some of it was financial, some of it loss of revenue to the company or to the firm, potential loss for customers or consumers. There were some operational factors there in terms of staffing availability or transactions being too high or too low. There was a customer perception. There was a reputational perception. There was our supply chain, what risks and what gaps do we have with supply chain? And then there was a cyber factor there when it came to data. So when we break this down, I don't know about you, but when I first started reading about operational resilience, I couldn't get it out of my head that this really seemed like a BIA. Those factors that we just saw on the previous slide felt like a lot of the assessment and impact assessment factors that we do when we do a BIA. So did I do this already? What's different? Now, essentially, one of the things, we're going to talk about this on the next slide in just a moment, but one of the things that I finally started to realize is that the two may have some very similar factors, but they're very, very different in terms of the goal and the information you're trying to get out of both of them, even though they may have a similar approach. And the reason for that is the BIA is trying to figure out how much time do I need in order to recover a process, or what's the goal of how quickly do I need to recover my processes and what order do I need to recover them before there's critical harm to the organization. Operational resilience is a little bit ahead of the game in the sense of taking a look at the organization and saying, what things do we need to monitor before we get to the point where there's a disaster and we try to recover? Now, Bryce mentioned earlier about one analogy that I have used and discussed with clients is the heart condition, analogy. If you had a heart condition, the business continuity is I've had an episode or an event or a heart attack or whatever that has caused me harm. I need to recover. So the recovery might be to call the emergency services, get me to a hospital. It might be emergency medication. It might be a resuscitation, a defibrillator. It may be a number of different things that resuscitate and get me functioning again if something bad happened. Operational resilience is a little bit more, it happens before that. And what metrics do we need to monitor to try to prevent us getting to the point where we have a disaster? So, for example, it could be in the heart analogy, our cholesterol, our sodium, our blood sugar, our blood pressure, our pulse, all of those various different things may be metrics that we want to monitor, and a major deviation on each of them should set off a warning sound so that we know that we need to do something proactively to avoid having a disaster. Now, the examples that we're going to show next, we're going to break it down into each of those different impact categories, but please bear in mind that there's a certain amount of idealism here where, operational resilience won't necessarily prevent a disaster from happening. But if we can get ahead of it and do various different proactive measures ahead of time as we're monitoring, it gives us a better chance of either being aware of a disaster and reacting to it faster, or even preventing it altogether. To illustrate this point, what Bryce and I have done is that we've shown a chart that shows a timeline. So if we were to take a look at the purview of BIA and BCP versus operational resilience, we can see that if something happens prior to a failure or something going wrong, we're assuming that our processes and our products are functional. We get to the point where we fail, or something fails, something is disrupted, an incident occurs, a crisis occurs, and then we have a recovery time objective. And that's the goal of one of the things that we look for. For those of you, you may refer to it as NTPD or MAO, but we basically need to know what's our maximum amount of time we have, whatever acronym you particularly use to define it. What time do we have to recover before there is critical damage to our organization? So when we do the business impact analysis, we're taking it from a different approach. For an operational resilience, we're actually monitoring and measuring and seeing what things could be indicators that would lead us to believe that we have an impending disaster. Now, that's going to vary from organization to organization. It's going to vary from industry to industry. So please forgive us in the fact that the examples we're given may be fairly high level in the sense of this is very much financial, but also what we want you to understand is here's an example of how you can apply this from a financial perspective. So for example, from an operational resilience, we may be monitoring, it could be stock, it could be revenue, it could be sales, it could be a number of various different things that we would monitor, whatever the monetary value of potential loss we may be deviating and trending away from what our normal is. Now, if we see that we've reached a certain warning threshold or a certain critical level, we may be able to put proactive actions to prevent further degradation. And the result is that we may avoid the critical levels are avoided and we resume normal functioning without having to declare a disaster and without having to revert to business continuity. Now, this is a very, very important point to note. Operational resilience does not replace business continuity. It can't. You still need the emergency procedures. You still need to be able to recover, because whatever proactive actions you put in place, they could work, they may not. Certain things may be inevitable, but whatever we can do to monitor and prevent is going to be in benefit to the organization. So let's take a look at how we would apply it from an operational standpoint. Let's go with our previous example where we had our timeline. We have, from a BIA and a business continuity perspective, we're functional up until the point we fail. Once we fail, we have 4 hours to this example. And I apologize, I didn't do more than 4 hours, but there's only so much I can put on the chart on the screen. But we have 4 hours to recover. Now, from an operational resilience standpoint, we could have analyzed, is there a risk of contagion to other business services? What are our dependencies? Are we seeing transactions are starting to fail? For example, as Bryce mentioned earlier, we might see that there's a change in market, change in interest rates, that all of a sudden everyone's calling in to refinance a loan or refinance a mortgage. And all of a sudden that happens to be the one day where 2 or 3 people have called out sick. So not only are we lower on staff on that day, but all of a sudden we've now seen a spike in traffic. What can we do, and how is that going to impact other products and services? If we've outlined the dependencies, which is part of the operational resilience model of products to critical processes, we have a better understanding of what we need to do. We may have staff cross-trained where we can increase the staff quantity for the growing number of transactions. And as a result, the dependent processes still remain functional, and we're not robbing Peter to pay Paul. And essentially, we find ourselves in a situation that we haven't actually failed. Things have stacked up, but now we've managed that and brought it back to normal without reaching the critical point of we have a failure and we need to recover. Now, from a customer perspective, what does that mean to a customer perspective? From a BIA standpoint, if something fails, customer will have to wait 4 hours until things get back to normal. If we start to see, let's use the call center and the support example. For those of you who've ever been in a call center or support center, you may see that, okay, somebody calls in, customer is reporting an issue. Another phone call happens, another customer is reporting the same issue. Another customer calls in reporting the same. Now we know we actually have a problem. And we're seeing an increase in client calls that we cannot deliver a service fully or on time. Now, this has got to the point where things may not have failed, but we're seeing a delay. We're seeing backup. We're seeing a problem. We've reached a certain warning threshold. Maybe if 2 or 3 clients call about the same issue, it's not a major issue. But if the product is a critical product, and we've reached a certain threshold where more than 20 people have called in, that may be a reason for the alarm bells for us to pull resources or to actually engage procedures to prevent reaching further critical levels. We have controls in place to improve the customer experience. We may have manual workarounds that we need to do before we've even gone to the point of declaring a disaster. No one's had to evacuate the building. No one's had to invoke business continuity, but we've reached a warning threshold before we've reached critical or fail. So we want to move from that warning level back to normal functioning. Now, the failure may still be inevitable. And also, some of you may have a BIA and a business continuity program where you've already thought about this concept and you may be already embedding this level of thinking into your business continuity program. Fantastic. That's a really, really good thing to see, because it means you're thinking about this in a preemptive way and a preventative way before even reaching that point. So let's take a look at it from a reputational standpoint. Same concept. We have the 4-hour timeline. We're functional until the point we're not. And then we have 4 hours to recover. Now, think about this from a reputational standpoint. If we analyzed and we understood that there's a potential impact, we have the right PR to actually engage the controls to mitigate the damage and get ahead of it. How many times, and I'll use a very simple example, if you've been had a flight delayed, or you've been waiting too long for food in a restaurant, What was the perception if they were proactive and communicating that to you to say, yeah, we know that there's a problem, we're on it, we've fixed it, and you'll get your food or you'll get on your flight within the next 45 minutes. It's a very, very different perception. It gives you the sense as a customer that they're in control, they're aware of it, and they're managing it. The lack of communication can damage consumer confidence and lower that. Now, how many times have we seen a situation where the lack of communication, where things escalated until the point where it was very, very critical, then crisis management team are invoked, then the communication goes out. If that communication happened ahead of time, earlier, because we were watching the right impact tolerances and we were aware of the warning thresholds before we even reached critical levels, it would essentially put us in a situation where we would have much stronger consumer or market confidence. Now, for supply chain, it's a little different because we don't really have as many controls in place to control a vendor or control what it is they do and how they handle things. But what we can do is educate ourselves on where the gaps are. For example, we may have a dependency, we may have dependency on a vendor. That vendor geographically could be impacted by, so if there's a flood or a fire or something that's affected us, that could affect that vendor in the same way if they're locally placed. We may be dependent upon an alternate vendor who is also affected. We may be dependent, and we saw this during COVID, where a number of companies were dependent on vendors who were using the same raw material source in order to produce their products. So if we're dependent on a vendor that's a single source, that's a particular problem. For those of you who may not be familiar, single source is maybe they're the only vendor that we work with that produces that. How much time does it take to go through procurement to get a second vendor? And that's not something we want to do at time of disaster. So being aware of those gaps, and if a vendor is able to meet those deadlines, activating alternate vendors earlier, before we get to a point where things fail, maybe the process is still hanging on by a thread and we're still just about meeting our deadlines, but we also puts us in a situation to give them adequate preparation to meet the needs. We may have a sole source vendor. A sole source vendor, for those of you not familiar, means they're the only vendor that does this. Can you imagine, the impact to a certain equipment manufacturer if they're the only company that makes that battery? If something happens to them, we're in trouble. So taking a look at our distribution channels as well, on the other side of things, not just the import, but the export part. Do we have only one distribution channel? What if they're affected? Do we have others that we can use? So understanding those gaps, some of that is already done in a business continuity program, but having an understanding of it on an operational resilience standpoint, where we're taking a look at, rather than the recovery after an event, but then how can we alert ourselves and be aware that we're trending in the wrong direction ahead of time, is a huge win. Now, for cyber, we took a slightly different approach in representing this. And the reason why we did that is because we don't typically get a warning 4 hours ahead of time that we're going to have a failure, or we're going to get a malicious attack, or somebody's going to try and hack us 4 hours in advance. So we can't really approach it in the same way. But what we can do is analyze our own integrity. So, for example, what's our restoration usage? What's the status of our backups? I mean, can we do a full backup? Do we only do a partial backup? Do we only do, how long would it take us to do that? Are our backups encrypted? Are we encrypted in flight? Are we encrypted at rest? What's our access control like? Are we role-based security, or are we zero trust? What's the policy that we have in place, and what kind of tolerance do we have where that could be exploited? From a malicious code, what's our visibility into tracking the malicious code? Do we have regional visibility? Is it global? We may have a point where we can track a certain amount of pings or codes that somebody's tried to hack us in country, but as soon as it crosses a border, we may not have any visibility to that. Is that where are most of our attacks coming from? Do we have to put blockers to certain areas and certain regions because that's where most of the attacks are coming from? What's our intrusion detection like? Are we worm enabled? The right ones read many. So from a cyber impact, all of these are going to help us form an improved cyber resilience, so that we have better impact tolerances where we can measure what are our risks. Now, on that point, once we've actually defined and got a good set of metrics that we measure and monitor for impact tolerances, we now go into the point, and this is part of an operational resilience flow, to test these out as scenarios. Bryce, I'll hand over to you to discuss how we test and the scenarios.
Awesome. Thank you, Andy. Yeah, so for our exercising scenarios, what are some factors that we can think about to test? And this list is not going to be, it's going to be very generic, but again, the goal is to give you an idea of what you can use as takeaways to maybe identify more specific factors for your own business. So we mentioned like data availability as a key metric for setting impact tolerances. Well, think about what would happen if that data was corrupted, deleted, manipulated, changed in some way. You might have certain services that hinge on key people. So think about testing what would happen if those key people were unavailable. They very, very well may set that tolerance for you that would trigger some sort of response. And then similarly, as Andy had mentioned with third-party services, your sole source vendor, your single source vendors, test and use those factors to test in your scenarios to see how they would impact your tolerances, because in the same boat, they could trigger and reach and exceed those tolerances for your services. Think about the disruptions that could happen to the market and the participants in the market. Specific to your industry, just think about what would happen and run scenarios that are based on market disruptions. And then if you're very dependent on technology for a service, think about what would happen if you don't have access or the technology is reduced to some point. You can play around with scenarios, including that factor. So again, this just some ideas to kind of get you started. And then once you're doing the scenarios, it's really important that we're making these, of course, as realistic as possible. That will give you the best insight and takeaways that you can use to develop your risks and respond appropriately. And then you want to do a high quantity of scenarios so that you can have some good takeaways to see, all right, where are my tolerances being reached in like what category? Maybe I have one scenario that's really exceeding my financial impact tolerance. And so those are going to be great takeaways that you can use and feed into your risk management. So stress testing is going to be very important when you're doing your scenario exercising. And then once you've done multiple scenarios, as I mentioned, you can take that information and that can feed into your risks, and you can handle it with your risk management methodology. So here's just a brief example of some charting to use as metrics that could be produced. You might want to use a software service that could provide you some analysis that you can use, and you could have some dashboards set up to identify, all right, for these services, I'm exceeding certain categories for my impact tolerances. And from there, you can expand your risk analysis. So taking this into risk management, your scenarios are going to reveal those risks that need to be mitigated and controlled. So from your operational resilience, you can feed into your operational risk, and then they can go through your processes of setting your controls to mitigate. And then anything that's left over could be handled within your business continuity practice and handled with recovery strategies for those unmitigated risks. So just to bring back the component overview again of operational resilience, thrown in products as that's really an interchangeable term here, service and products. This is really where we see operational resilience broken down. And Andy, I'm going to pass it over to you to kind of tie it back in more with risk analysis and business continuity.
Absolutely. Thank you. So just to tie this all up before we wrap up and get into any questions, From a product standpoint, for those of you, not all of you necessarily may do a product BIA. For those of you from a European standpoint, may be doing product BIAs, and it also may depend on what industry that you're in. A product BIA gives us a chance to define what our critical products are or services, depending on what you're doing, and what the dependencies are on critical processes. Some organizations may go straight into doing a process BIA. There can be an advantage to doing a product BIA because by doing so, it's another layer above that, and it also sets the groundwork for operational resilience. You could have a product BIA define what the critical processes are, and then a failure of a critical process could affect a product that crosses more than one department. When we think about our critical processes, the BIAs are usually done department by department because they're the people who are the experts in that particular critical process. But it takes multiple departments to produce a product. So having an overview and understanding here actually gives you a very, very good aggregate of the impacts if something happens. When we take a look at an operational resilience strategy, we're taking the products that we've already defined. You've already done half of your operational resilience if you've done a product and process BIA. You've already defined what your products and services are, and you've done your dependencies. And if you've done your BIA thoroughly, you've also defined what the technology and equipment you're dependent on as well. So for our operational resilience, we're going to define what those impact tolerances are and what those measurable areas are. And that's going to differ and change depending on your industry, as well as the level of maturity or things that you find may be measurable. You might find measuring rates of transactions is just too much and it's not feasible. If you have the right metrics or the right digital equipment in place, you may already be measuring some of this in a support center. So there may be areas that I can just plug into this and pull that data in. So we take that operational resilience, and what we find are our thresholds. And if we don't have the right controls in place, we find enough gaps from a supply chain or a cyber or a customer perception perspective, those are risks. We can put that back into our risk threat analysis and go through the motions of doing our threat risk analysis, figuring out what our mitigations and our controls are. Now, what we can't control and what may still exceed a risk appetite, we may need to put back and take into account as we're developing our business continuity plans, because we're still going to need to recover. We may be looking at a situation where, okay, if these scenarios happen, we're going to put the controls in place to try and prevent them, but they still could happen. In which case, what's our recovery strategy should those scenarios happen? And then overall, we're going to want to exercise not just the planning piece, but the scenarios that we test with operational resilience. And overall, that overall flow is really what's going to make up the enterprise resilience for our organization. So at this point, this brings us towards the end of our webinar. We're going to take some questions now, and also quite happy to, for those of you who want to actually take a deep dive and actually talk to us offline, our information. Bryce, if you wouldn't mind putting our slide with our emails, we'll put that up on screen so that we can go ahead and respond to those as well. So anyone wants to email us if they don't want to ask the questions. So. We did have our first question said, so how do you describe impact tolerances as to what is done to prevent going into a BC or disaster recovery mode? But in other presentations, I've heard it as after BC or DR efforts didn't work. And how long can you operate in a disrupted state before you end up having to have an exit strategy? I actually will answer that live. So in the way that I've actually interpreted it and the way that I've read it, it's been a lot more of a preventative mode. And I think other people have had other interpretations to it. So for example, if you take a look at it as, it depends on the point where you consider you're in a BCDR mode. So, or you're in a recovery mode. So for example, the way that I defined it is when we were looking at our impact tolerances, we're measuring the various different factors, whether it's transactions, number of staff, whether it is financial impact. I defined it as we're trying to be preventative and prevent something from happening before we declare a disaster. You may decide that, okay, if I hit that warning threshold or hit that trend, then we're technically in recovery mode, in which case we're still going to operate in a disrupted state before we actually have an exit strategy. So I think it's really, it's the scale as to where you want to place that and where you want to put that. And I hope that answers your question. If not, please feel free to email me and I'm happy to have a longer discussion on this. If you would like. Simon, thank you. Am I right in resuming tolerance measurement as a way to formalize the detection capacity towards the impact types described in the BIA? Somehow it relates to operational threat monitoring and defining metrics for near-miss events, right? Yeah, that's also the way I understand it as well, because I think a lot of the tolerance measurements do it does actually increase your detection capacity. And depending on the impact types you want to apply, some of the ones that I define may not apply to you, and it may not necessarily resonate, but some may. And it is a certain amount of threat monitoring. So, but when you're monitoring a threat, how do you know when you're reaching a point where you're crossing over the line of, okay, we're actually in the danger area now? So there's a certain amount, in my opinion, there's a certain amount of threat monitoring, but you also need to do the pre-work to understand what are the thresholds of what you can tolerate. So when you're monitoring, if it reaches that threshold, then I can actually sort of, okay, we do have a near miss event, or no, we've crossed over the line and we're actually in full recovery mode. I hope that answers your question, but if not, please feel free to reach out to me directly and happy to have a deeper discussion. Any other questions from anyone? We will share the session slides, and please feel free to reach out if you do have. Oh, yeah, thank you very much, and you're very welcome. Our emails are right there on screen. Please feel to reach out to us if you have any further questions or you'd like to see how we're solving some of these. We'll be happy to have that discussion with you. Thank you for attending. Very much appreciate it, and have a good rest of your day.